Yo, what's going on? It's your boy, Check Investing, back here with another video. All right, I'm going to be going over a very special episode today. First of all, I've been doing daily NQ and weekly NQ and ES reviews. Make sure you subscribe to my channel, press that subscribe button so you don't miss a single review. It's going to be very important because as you're trading NQ and ES, it's good to hear from someone who's a little bit more experienced. What they're thinking about the market, not so that you can copy me, not so you can just go along with my bias, but it'll help you when you're doing your individual trading, right? So you'll be able to look at that and be like, wow, like, okay, so he was thinking what I was thinking there, or, maybe I didn't see this. And so this is going to help me when I'm developing my bias for the next week or the next day, or why did something happen today versus something didn't happen today, right? So make sure you subscribe to my channel. Go check out my playlist for daily NQ and weekly NQ reviews and ES as well. That is where like you'll be able to see. I'm basically reviewing NQ and ES every single day. I'm dropping a video every single day, and at the end of every week, and doing a weekly review. And I'm also going over the flagship model that we trade on this channel as well in that playlist. It's called the ICT 2022 model, right? So make sure you like those videos, subscribe to them, and press the notification bell so you do not miss that. For those of you who don't know what the 22 model is, we'll be going over that in a second. But what are we going over in this video per se? I want to go over my risk to reward strategy. Now, a lot of people don't really know how to target R to R, right? They don't really have a strategy for taking out partials, and they don't have a strategy for getting out of a trade really quickly, right? Like a lot of people will just hold the trade all the way until their stop loss. When a lot of times, like you can actually pull out of your trade prior to that stop loss getting hit, right? And you don't want to do that just because you're afraid. You need to have a very technical reason for why it's most likely for this trade to go against you. I talk about this a lot on my channel, but here is going to be a short synopsis video on how to best do this, okay? Before we get into that, if that's something that you're excited to hear about, press that like button. You can press it right now. I'm not asking for no money. Literally just press that like button. Thank you very much. Word. All I need you to do next, all right? You see what I need you to do next? Click the description below, go join my Discord, because then you're gonna see the trades I'm taking every single day. Type, all right, and then you're gonna like get involved in the community and you get to ask me questions directly. All right, doesn't that sound fire? I know it does. So why don't you just go do it? All right, press the like button as well. Don't forget that, and subscribe and press the notification bell. You can press all those things right now, buddy. You can just do it right now. All right, now let's get into the risk to reward strategy. Now, personally, for my model, let's go over what the 22 model is. 22 model, right? This is from ICT's 2022 mentorship. If you have not watched that, that is one of the most, if not the most helpful series on trading in the entire of YouTube, right? Like that stuff, like is no matter what you're trading, you need to go watch that because that will just help you really understand how the market moves in general. All right, so let's go over ICT 2022 model. So it goes like this: create a high, low that takes out this previous low, breaks market structure right here, right? Comes back down into a fair value gap, and then goes higher from there. Now, take it a step further. Why did I say break up market structure, right? So market structure could be like this. Make a high, low, higher high, lower low, higher high. Sorry. Lower high, lower low. Lower high than this high, right? The reason I'm calling it a lower high is because it's lower than this high, right? The reason I'm calling this a lower low is because it's lower than this low. Lower high, lower low. This means we're bearish. Every single time we're coming back into a premium, we're just falling again, right? But what I mean by break of market structure? Break of market structure is when we've made a higher high than this high right here. We come back down and dip into a P array, which is going to be a fair value gap. A fair value gap must be present, right, for this to be qualified as a 22 model. Now, I go over in this channel a lot that it doesn't actually necessarily always need to come back down. It's a fair value gap. It can, the lowest hanging fruit threshold could be this high right here, especially if we close above the high. It can come back and just tap this high and keep going higher. This would act as a breakaway gap, and price would just continue going higher from there. It's actually a really good sign if it does that, because then it shows you that we're so bullish, it doesn't even want to come back down to this discount array. It just wants to keep going higher, right? So it just goes higher from there. That is the 22 model. This also kind of looks like a lot of retail patterns as well. But the key is that we've swept liquidity as well. But just think about like some other patterns you look at, like wick off, like just like this is like a classic going into from an MSM to an MBM, right? Like This is like one of the most flagship, like easiest ways to just enter the market, especially catch really long term swing moves. Because this is typically a reversal strategy, but it can also be a continuation strategy as well, where you're purging some short term liquidity in a upward move, and continue going higher on a continuation purge. But that is a lot of lingo. We don't need to go over it. Like we can just keep this really simple for this video, right? So this is the 22 model, right? Let's go over an example so you can see it live. Um, and give me one second here. Hello, babe. Hey, are you? I'm recording a YouTube video. Are you downstairs? Okay, okay. Just call me. Call up, and yeah. All right. No worries. I love you. Bye. All right. Sorry for that, guys. Okay, so that's the 22 model. Now let's go over a classic example. We can see even right here. Look at right here. This is what we will call a 22 model right here, right? We've made a series of lower lows. This is a high right here, lower low, lower high, lower low, lower high, lower low, break of market structure right here. Decent close above this high. And we are in a kill zone, right? Because this is the PM session. This is the PM session, right? What time is this? 2:20, right, to 2:40. This is a macro, right? 2:20 to 2:40. That is a macro time of day where you can get some pretty decent price action. We have these LRRs right here, plus these relatively equal highs, even though this high took out that high, so it's not that nice, but relatively equal highs liquidity here. We're in a discount, right, of this move coming back down here, right? We purged this low over here, and we had a break of market structure with a fair value gap. This low took out this low, break of market structure, fair value gap. All right. So that is a classic 22 model. How would you enter? Enter here at the low, that fair value gap, and keep your stop below 3 PD arrays. You have this breaker right here. You have this fair value gap, and you have this inversion fair value gap right here, even though it's really hard to see, right? You have that inversion fair value gap. Right here. Look at how price respects that inversion fair value gap. We literally touched the low. Like, look at the low of this candle. What 20,148. High of this candle, 20,148. That is perfect. Like literally, look, this next candle, consequent encroachment of this BISI right here, right? What is the consequent? Like, look at that candle, bro. Like, don't you can't tell me that this is not like, bro. You can't tell me that this is not like how to trade, bro. Like, we're literally touching the consequent encroachment exactly on this way. We're touching the low exactly. Like, this is a real PD array that's respecting price action. All right. Now, and even so, there's a small value imbalance in here, but that's okay. This is the civvy right here. All right, that's the inverse value gap. Look at how we're respecting that. All right, so that's 3 PD arrays, and you could have kept your stop below. Let's just say this candle, just to be safe. I have to keep it on the candle that is below the third PD array, right? So we can keep it below that candle. Aim for a 1 to 3. Now this is not a great example because it didn't hit our 1 to 3, but this is I can teach you guys a little bit about how I would manage my stop. Now, one of the things, like I like to target a 1 to 3, right? 1 to 3 is typically what I'll do for my 22 model. And we'll go over another example because maybe this one is really not the best one. But you know, a 1 to 3 can afford you a lot of things. 1 to 3 is what I think is the secret sauce to the risk to reward strategy. And let me tell you why. Because 1 to 3, first of all, a 1 to 3 is a very nice target in the sense that if you lose once, like you need to lose the next 3 trades to break even, right? Now, let's take it a step further. It also affords you to take partials because typically what my strategy would be is I would enter on this fair value gap right here. And then once price gets halfway to my take profit, I'll take half of the trade off and let the rest run to profit. So that way, I'm at least aiming for a 1 to 2. You can do the math on that. If you take out half of your trade at 1.5 R, that's 0.75 left. The rest of it is going to be you're taking now half of your trade is at the rest of that 0.75, right? Like that together will get you to will get you to about what does that math? The math's about 1.5, but I'm not really sure how it works. But you get to that 1 to 2. I know that every single time, like I'm actually pretty bad at math, but I know that every single time that once I take out half my position at half R at 1.5 R, if I hold the rest of 3, then I'm typically making at least 1 to 2 on my cheddar. I might have not done that math right. Oh, you know why? Because I'm so stupid, right? So you're leaving, like, you take out half of your trade at 1.5 R, but you're taking out the rest of that half at 3 R, right? So half of your trade is making, a little bit above, 2R, and then you're making like 1.5 R in the first half. So like that together is going to add to 2, right, in the middle. And so you're like, just trust me on the math. You're gonna make twice as much as you invested if you take out half of the partial at 1.5 and then take out the rest at 3. So that way, like, you've taken partials, right? Plus you've made like you've taken partials, you've pulled out like half of your trade, you now, and you move to break even at that point, right? Once it gets halfway, this price should not come back down. Like, and you see that when it comes back down here, like the trade is no longer valid, right? Because this is actually a good example to teach you guys how to manage, like, your R to R, right? And manage your risk. Like, once you get halfway, we got to halfway around this point, and we're taking half the trade off. If it comes back, that's when I break even. Look at how we just get stopped out here. Like, it's good to take off half your trade here and then move to break even. Over time, like, you will make more money this way, right? Because like you'll at least be locking in certain profits. Like, a lot of times, like, price can be very finicky, especially like right now we're around election season. Like, this is time where you should be taking out partial and moving to break even at a reasonable time. Like, you should not just be holding trades all the way. Another reason is because we're inside a weekly fair value gap, right? Like, look at this weekly fair value gap. Like, we haven't really closed. We haven't closed outside of it yet. And we had this daily fair value gap as well. So like, look how much chop has been there around past few recent days, except for today, really. Where we closed out of it yesterday. But price can be really choppy, right? Especially around election season as well. So don't want to hold for your full targets. Like, you don't want to hold it for your full targets without taking partials, and that's a general practice for me. Now, here's another tip and trick that I would use when you're talking about your R to R, right? You really don't want, like, when you have a one fair value gap like this, you really don't want to see price closing through it. So you don't want to see it closing through the consequent encroachment of this. So when we entered this trade, it wicked off it. That's a really nice wick. I would like to see price expand away from there. The best 22 models that are most likely going to hit your take profit are when they just immediately expand away. Like, they come here, maybe they touch it once or twice, and then they expand away. But this one, it teetered around here for way too long. So I would have taken off once it closed through this particular consequent encroachment right here. I would have taken off at least half my trade. I would just take it off and then leave the rest of my stop loss. What are you doing there? Like, you're basically amplifying your risk reward, because when you take off half the risk, like, basically, before it even hits full your stop loss. Let's say, for example, that's like $500. You take off half, you only like lose about, like, you take off half of that, and so that even if it hits your you take off half of it at the halfway point and it hits your stop loss, like, then you've only lost like $350, right? As opposed to losing the full 500 if you're risking 500, right? But let's say it goes in your favor, like, you're gonna make at least a grand. So instead of losing 500 or risking 500 completely to make 1,000, like, you're only risking 350, right, to make 1,000, which is really a 1 to 3 R. I'm hoping that this is making sense. Like, so this is like this is one of my strategies. Like, if price is staying around here for more than 5 minutes or so, for 5 candles, or it's coming through this fair value gap right here and it closes through the constant encroachment, especially with speed like this, I will take off at least half my trade. And then let the rest ride. Like, if we get a nice, really large breakout, like, then I'll put on the other half and then put it below the recent low and let it ride to take profit again. Because that's how you're really managing risk. So this is like a really good R to R strategy here. You can see, like, once we took out this high, like, we just came back to the break even. And so I would have made, at least half my trade and then just stopped at break even and really managed my trade very well. I can show you guys another example as well. Go over, let's find another 22 mile. That makes a lot of sense. All right, so this would have been a great one right here, right? We're in that 10 a.m. silver bullet, like, medium. And what happened here? We have an opening range gap that we, like, basically filled last night. This is Friday. This is last Friday's opening range gap that we had not filled last Friday. But we filled it on ES. So I was expecting at some point we would come back down and at least fill it on NQ. And we're in such a steep discount. If you look on the 1 hour, we're in such a steep discount We're at such a steep discount here, right? Coming from yesterday. This is around the 10 a.m. Today on Friday. Yesterday we ended at such a steep discount and we didn't at least trade back to equilibrium of this move, right? Like we still had equilibrium to go to from this 20,212 level, right? You can see it once we get there around there, we just start wicking and then we come back down, right? Like this equilibrium level would have been a good draw. Plus you have this 1 hour SIBI here. You're in a major discount and you're reacting off of that PD array, right? Like that's a textbook setup, right? You're reacting off this PD array right here. Textbook setup, especially like on a Thursday where you saw a large expansion on that next Friday, you can typically see price go back higher the next day and retrace some of that move, that large expansion from Thursday, especially if we had a large fall off or if we had a large rise, you can see Friday come back in the range. This is also like a TGIF, right? Like if you have a large weekly candle, you can see here, this is that TGIF play. If you have a large weekly candle, you can see it come back into at least 20 to 30% of the range, which you can see right here, we came back into at least 20% of that range right here. You can literally see that, right? Like, look how we closed within the 20 to 30% of the range. So if we're down here on a Friday, like, especially when a Thursday made that move lower, you can expect Friday to come back into that TGIF level. So that's the draw on liquidity there, right? And so it's 10 a.m. We're still in we're still in that area where there's a large discount, and we have not come back to that 2212 level, the right 2212 level around up here, and we have a 22 model that is showcasing itself. So I'll show you guys where it is, and this is a classic example of how 22 model can also be a continuation strategy, not just a reversal, right? So we have a series of higher highs, right? So high, low, high, make a low. But look at what low we take out. We take out this low and we take out this low. Right? You can see that. We take out this low and we take out this low right here. We close through this fair value gap. It's an inversion fair value gap. Plus, we're bullish. Like, this is really important because we're bullish. And it's in the right time of day, right? This is a 10 a.m. silver bullet. Drawing into that 1 hour SIBI plus the equilibrium. So we have a rise higher. We close to this inverse fair value gap, take out these lows, break market structure above here. Look how we break market structure, making a higher high, right? Come back down into this fair value gap, and this is beautiful. Look at how we like don't even, if you look at this fair value gap right here, look at this upwards fair value gap. We don't even touch the consequent encroachment of this, right? Like we just keep expanding higher. The best 22 models, like I said, like if we go in for a 1 to 3, the best 22 models, like I said, like they just expand immediately after, right? One, we touch this fair value gap once, and we just start expanding. Once we close above this high, I'm setting my stop loss to around here. I don't want to see it come back into the fair value gap. I want to see it expand away, right? Once we get to halfway, I would take off half my trade. Once we start teetering around like my take profit right here, I would start taking a lot of partials, right? Because think about it, like I don't need to wait for it to hit my full 1 to 3. If I see we're not expanding immediately to my 1 to 3, like sometimes I can get real close to my 1 to 3 and like price just starts moving away. You'll see that in your trading as well. Like this is still a 1 to 2.99. This is still 1 to 2.55 right here. To 1.295 right here. Like just pull out like most of your trade around here. You're practically making the same 1 to 3. Like you don't need to wait for it to hit your full take profit because you have OCD. Like you're in the business of making money, not being perfect, right? And so we get here, and I'll take off half my trade right here, and then once we get to the like around this level, I'll start taking off more partials, especially if I don't see it expanding like further to my side. So like maybe on this candle when it came back down, I will just take off like most of my trade and only leave like maybe 1 or 2 contracts left here, and then it can finally hit my take profit. But let's say there was a different scenario. Let's say for example like price, because it's election season, sometimes it can be finicky, and we didn't have like a really good draw on liquidity. Let's just say for example it came back down here and it closed through this 1 minute BISI right here. I'll take off half my trade, right? And then let the rest run to my stop loss. If we had closed through like let's say the constant encroachment and this inverse for a leg gap, and I know price is really bearish, and I probably take out the rest right here. And so what you don't want to see is like when you start seeing like very like one or two very obvious reasons for price to like just go through and match take out your stop loss, like you can minimize the risk that you're taking by actually pulling out a little bit of it early when you're seeing the first kind of signs of negative price action. This is also why it's really important to trade in like low resistance liquidity environments, right? Like when price is expected and anticipated to move well, because then you like won't have to pull out early. Like price should just be like tapping discount rates and just like riding higher. It's very low resistance, low resistance environments because we are in a steep discount. We're acting up a PDRA. We have to head towards equilibrium. It's a Friday and it's 10 a.m. silver bullet time, right? And we didn't have that much movement overnight, right? Like very little movement during London and Asian, right? So think about it, like accumulation, distribution, expansion, accumulation, consolidation, and distribution. Price is consolidating here for a little while. It's time for price to start expanding away. Once we get into that 10 a.m. Silver bullet time. And so this has been like a little short lecture on like R to R. I really like to target 1 to 3s because it allows me to take that nice partial. I know exactly when I want to pull out of my PD array. When we fail a PD array, I can actually lower my risk and actually maximize my upside. And I have a good partial strategy. I have a good time to get out. And so yeah, sorry for the yap session, guys, but this has been a really, really short review on R to R. If you guys have any other questions, please write it down in the comments below. Make sure you join my Discord and press that like button and that subscription and that notification bell, please. Thank you very much, and I'll catch you guys next time.